Instead of like paying rent,
Yes.
like I've been paying rent for example, this house,
Yeah.
even if I paid rent for like even 25 years,
Yes.
there's no single way naweza kuwa na opportunity ya own this house.
Yeah.
If I have an opportunity to pay rent, the same way I'm paying rent, but maybe sana niongezea kitu kidogo, I possibly pay for my own house.
Yeah.
Because after 25 years, I will eventually own the house.
You'll eventually own.
Hi everyone, I hope this video finds you well. My name is Martin. In case you're here for the first time, na sisi ni watu wa insurance. We do civic education as well as reviews on insurance, especially within the Kenyan market. Now we are super excited to have this conversation today because we are tackling a subject that is very sensitive.
Absolutely.
If you make this mistake, most of the times people don't have reverse. Umepatiwa opportunity ya kuchukua mortgage by a company because you have a good income. So uko hapa hivyo kwa you want to make a decision whether to take a mortgage or maybe to do an investment and wait, probably build later.
Yeah, sure.
So today we want to talk about or to compare for someone who has an option of either investing or taking a mortgage. Akona float.
Yeah.
So akona float akona hiyo option ya kuchukua mortgage. Lakini pia nafikiria, should I take a mortgage or should I put my money maybe in a money market fund or maybe that kind of an investment. So we want to really compare what do you get most value, or at least we avoid making mistakes. Yes. So maybe you can help us dissect.
Good. Thank you so much, Martin. And it is an interesting topic because every day, whether you are educated or not, one of the major things that we must deal with at the end of the day is do you have the money?
Yes.
Or how much do you have? So, you know, because we come from Mlima. That's a conversation we really like having.
Yes.
And today, now that you've talked of a mortgage, a lot of us have an opportunity of taking up a mortgage. However, it's not always the best option. And first of all, it's important we dissect and inform our members what is a mortgage in the first place. Basically, a mortgage is just a normal loan which is named to kind of attract you to take it purely for homes. That is, instead of you having to wait for a long period so that you can build your home, you are given that option of having a loan purely to kind of own a home today. However, from my point of view, because I believe everyone has his own view, I can advise you against having a mortgage because one, it's a long-term loan, such that you've tied yourself for a very long time, and it's in the long run it might be very, very expensive. And this is what we can compare. If you had an option of taking up a mortgage and you had a colleague who also had the same opportunity but instead opted to have a money market fund, what would be the implication possibly in the next 10 years, 15 years or even 20 years? So for number one is that this person who is taking up a mortgage, you deny yourself what you call liquidity. Unlike this person who has taken up money market fund. Remember, by the time you are accumulating, if something comes up midway, you have some liquid cash, which can help you to even diversify. So mortgage usually takes from, I think, 10 years. You can take up a mortgage of 10 years, others 15 years, other up to 25 years. But that largely depends on Number one, your year, your age, and possibly the much you can afford to repay. Yeah, so what you will find, because mortgage is a loan, it has some interest tied on it. And a lot of banks provide that kind of loan. And what you'll find is that the rate ranges from 10%. It can go way up to possibly 15%. However, mortgage, remember, is a loan. It's just that it has been named a mortgage, just like we have a school fees loan, we have emergency loan. So do not mistake this to be a special loan. So the rate keeps on changing.
Maybe for someone who is not very careful with numbers, mtu anasema instead of like paying rent,
yes,
like I've been paying rent for example this house,
yeah,
even if I paid rent for like even 25 years,
yes,
there's no single way naweza kuwa na opportunity ya own this house.
Yeah,
so maybe it makes sense. It will make sense for someone who is not sensitive with numbers. If I have an opportunity to pay rent, the same way I'm paying rent, but maybe sana niongezea kitu kidogo, I possibly pay for my own house.
Yeah,
because after 25 years I will eventually own the house.
You'll eventually own.
So does it make sense in terms of numbers?
No, and I will be very frank. The very first thing you need to understand is that the moment you own that house, every other cost now moves from the owner of the house now to you. Look at this. You could own that house, possibly let's say 10 million. But there are a lot of other costs that comes with that. Number one is that you could require an insurance policy for that house. Number two, we have the utility bills. Yeah, you know, when you are under an apartment, you kind of share that. There are other costs like land rates. There are cost of maintenance. There are cost of maybe if it's a 2 or 3 bedroom, you need someone to keeps on checking the house status. There is depreciation. There also, you may be forced to bring in someone mwenye tunaita house manager because it's too big. So what you'll find is in the long run, it does not really make sense. And I can do it in terms of figures. But before I even go to that, because we shall look at them, if you own your own house and another one is renting, and that person who is renting opts to invest the money which he would be otherwise putting up towards the mortgage. But the most interesting thing is there are a lot of opportunities you have locked. The moment you buy or you do a mortgage loan, let's say you bought a house worth 10 million. If you find an opportunity worth, let's say 800,000, can you liquidate?
No.
You cannot liquidate. Number two is that every month you are paying more than you would otherwise be paying for rent. And mortgages are quite expensive. We shall come to numbers, but first of all, let us look at also the risks. Yeah. So for something like money market fund, there are no risks, or they are very low risk, because where the money is usually invested, it's put under what we call T-bills, T-bond, bank deposits. But you know, when you do a mortgage, there are risks of if you lose your job, what happens? Is there an insurance?
You're not able to sustain this mortgage loan?
Yeah, at the same time, good. At the same time, there are no insurance that covers loss of job. So you could also lose your house. What happens if you had that mortgage and you didn't possibly take up a mortgage insurance? Your family loses the house. Again, there's also a risk of the bank rates keeps on fluctuating. One day they are telling you we have given you with 9%. The other day it's 14. The other day, so those changes ultimately will affect your pocket. The much you thought possibly you would end up paying, you by the time you are finishing and you do your calculation, you find that you've spent quite an enormous amount, as compared to that person who opted to keep on renting. Again, it's on the returns. What benefit do you get out of having a mortgage?
Avoid paying rent.
Just that. Is there anyone who have died because he's paying rent?
Somebody maybe would argue for someone who is not paying rent. Maybe they are saving up. Oh, okay. Even for the one with the mortgage is paying rent.
Yes. You know so you are
the landlord is different. Landlord is the bank.
Your mind has just been conditioned to think that you own the house, but you don't own the house until the term is fully paid. So you're still paying, and on top there are some other costs. Again, when as compared to that person who opted for money market fund, every month your money is earning an average of how much? Let's say 10%.
10%, yes.
And you are being charged around 13%. So by the time you are finishing up that loan, you will have bought like 2 or 3 houses. As compared to this guy who opted to wait. The only thing we don't have is patience of waiting. And I want to show you a very simple example. Assume you take up a mortgage, let's say of 25 years. That is close to 300, or it's 300 months. So if you take up a mortgage today of 25 years, that means 300 months gone. So if it's valued 10 million, the average amount you would be required if you are paying that loan at an average rate of 10%, every month it will require you to cough 87,000. 87. So what does it mean? By the time you are finishing up 300 months, you'll have paid 27 million. That is interest plus your capital. So you have, number one, for the last 300 months, you have paid interest of 17 million and the capital or the price of the house of 10 million. So we may have some argument that if you wanted to sell the same house in the next 25 years, it would probably cost more. I agree to some extent, but remember, this from the word go, it was not an investment. You had bought it as family house. So, but, and again, look at this. All along for 300 months, you must have encountered countless opportunities. So many opportunities, but the money have been locked for possibly you've lost more money than you
in losing opportunities to invest.
Good opportunity, we call it opportunity cost. But look at this person who have taken up a money market fund. This guy who is paying mortgage, he's paying around 87,000. Let us flip that and look at this guy who has opted for money market fund. And instead of putting 87,000, let's say he does 50,000. So same time,
so we say like he gets a house where he can pay a rent of that 7,000.
Good,
but 50,000
yes,
he puts into a money market account.
Good, exactly. So in the next
25 years,
guess how much he will have? He will have 67 million. 67 million after the same period. So this guy, yes, has lost 37, but after that period, the much he can show is 67 million. So he can possibly even choose to, now instead of struggling a lot, because what I said is that you don't die because of renting. Assume you put 67 million under money market, and now you can do this. Let the money market be paying rent for you. Possibly you can die even without having exhausted the money, and you have financed your lifestyle, because on average 1 million can give you approximately 10,000. So if you have 67 million,
how much?
So it's 10,000 times 67.
That is 670.
Around 70,000.
70, yes.
70,000. And your capital is 100% preserved. But this guy could be having the house, but he's sleeping hungry. That is why it is important you do this calculation. Number one, we have said it's risky because of the rate change. Number two, having a mortgage, sometimes it may be very, it may end up being expensive because of the rates. I mean, not the rates, but the other other costs, which majority of us may not really factor in. And number three is on liquidity. You are never liquid because your payslip has been
really squeezed.
Yes.
If you wanted to invest somewhere else,
you would not have the money. And again, there is no return. It's a dead asset. Remember, this is a house. And a family house does not give you money at the end of
the month,
unlike that person who put up that money in what we call money market fund. So that is why it is very important. Even as you think of this, either a mortgage, or what I would advise you is to have patience. Why don't you, instead of giving away your 50,000, continue renting, but the money you would otherwise be, because sometimes you could also be having a mortgage but you're still renting. Could be it's a fresh product project. So it might take you 6 months before you move in. Mortgage doesn't really mean that you are buying a ready-made house. No, sometimes it may be under construction. So it may take you 1 year, 2 years. So the most important thing is to think in terms of what is the value am I getting from this particular investment. Because one, mortgage is not an investment. An investment or an asset is anything that is taking
money from your pocket,
that is giving some money in your pocket, or putting some money in your pocket. While a liability is anything that is,
even if it looks like an investment, so long as it's getting money out of your pocket.
Good. A house on mortgage, it's a liability. Or even a house without mortgage. Your personal car is
so when you are doing the balance sheet, unafaa kuziweka kwa side ya liability.
Those are liabilities. They are not assets. Sometimes we mistake that. So the most important thing is to have someone you can have this conversation. And that is why we are here as Kenya Insurance Hub. We can teach you on how to
spot best investment opportunities that would probably
give you more value. At the same time, you can also look at different investments like rates. If it's
real estate investment, something
good. So if it's rate, money market fund, bond fund, special funds, wealth management fund, that is what we do best. And we can show you different rates for different companies, because majority of these investments are done in-house or within the Kenyan boundaries. And we can always guide you. So feel free to reach out so that we can have this conversation.
Yes. I also think maybe we can have a taste of those people who have already taken the mortgage, but when we what the experience has been.
Good.
Do you feel like you have made the best decision? And if you are maybe in the process of kulipa na nini, how is it for you? Would you, if you are given an option like to do a different thing, would you like go for the same? That is a mortgage. So we need to have that conversation. Maybe you can help us know, for those who have mortgage. Let us know in the comment section what you feel about the subject, and if there's anything that you really want to know about insurance. We are open to have those topics. So keep sending those questions and we'll be able to respond with detailed videos such as this one. And we hope that we give you value for your time. And until we see the next one, God bless you and
Bye bye.
Bye bye.